Heidelberg Cement's June quarter performance was better than expectations, and that is despite the COVID-19-led lockdown. In our Ideas for Profit today, we'll discuss why this mid-sized MNC cement player is a must-review candidate in your shopping list. Well, revenues in Q1 fell by 30% year-on-year, and on the back of COVID-induced shutdowns that was. Now, cement offtake for the quarter stood at 0.86 million tons, down 32% year-on-year, and that was mainly on account of the nationwide lockdown. Now, operating margins were stable, and that is despite the contraction in the top line. EBITDA dropped by 32% due to the contraction in the top line, and also COVID-19 led interruption in the demand as well as in March and April. But actually we saw a little bit of improvement in May and June, and that was on the combination of pent-up demand, also monsoon related maintenance work, sturdy offtake also in the rural areas. Now, in terms of operating metrics, cement realizations came in 2% higher on the back of robust pricing environment in the central region and higher offtake in the retail channel. Now, raw material costs spiked, but the cost savings from waste heat recovery system plant and reduction in freight expenditures, they all supported the margin profile. Now, despite the 2% increase in cost base, the EBITDA per ton rose to 1260 rupees in Q1 FY21. The cement demand and prices have definitely slackened over the course of, say, July to August with the arrival of monsoons. The sluggish execution in infrastructure also continues to weigh on the overall demand trajectory as well, which actually remains quite skewed towards the government-funded road projects and also irrigation. Now, cement dealers as well as the management, they all expect both the demand and prices to rise post-Diwali. However, the spread of COVID-19 infection to rural areas, availability of raw materials such as sand, and localized lockdowns, they all remain key areas of concern right now. Now, utilization levels in the past 2 quarters have been much lower owing to the capacity expansion and also the demand disruptions. In FY20, the company also undertook debottlenecking projects to enhance the grinding capacity. The balance sheet is cash rich right now. The current capacity offers sufficient headroom for capturing the market growth in the next 2 to 3 years also for the company. The company is also evaluating proposals for expansion in Western and other regions as well. But all those plans have also been put on hold, and that was also on the back of the pandemic. Now, the company has exhibited strong resilience to the impact of COVID-19, and that is thanks to its strong market position, robust demand from the end markets as well. Now, the demand recovery has been quite swift on account of normalization in the supply chain and healthy cash flows in the rural markets, but the sustenance will be challenged by frequent and sporadic lockdowns as well as rising COVID cases. Now, the margins, however, stand to benefit from lower fuel and other input costs. Now, we do maintain a positive stance on Heidelberg Cement, as the industry dynamics in the central region are quite favorable due to the low capacity additions as well as the robust demand recovery that we are seeing. Now, the company's comfortable liquidity position and also the strict cost focus, that provides comfort as we expect the company to weather the ongoing disruption. Now, the stock could be kept on the radar for accumulation on dips as the company enjoys strong position in the central region.